Coming to you, Mayuresh, first of all, welcome and good morning. What's your opinion at present around the mid-cap space, and if there is anything you like? There is very strong momentum in the last 1 month in the mid-cap space.
So morning Piyush. No, I think looking at the earnings trajectory that a lot of companies have looked forth in the quarter gone by, and if one really assumes the expectations in terms of the earnings profile in the next few quarters to come, I think we are very, very selective on mid-cap. So I think selective stocks in the mid-cap cement space, for example, stocks like Heidelberg, where our belief is that utilization levels will inch up higher from the current 85%. The realization should also improve, and because input cost pressures are coming down marginally, we're probably going to see an improvement in an EBITDA per ton performance as well. Again, the cost efficient measures that the company has taken with the 12 megawatt waste heat recovery, and again with freight cost expected to go down, I think these elements are probably going to augur well in terms of an earnings profile. Selectively, I think mid-cap consumption as a basket is also expected to do well. So within that basket itself, I think the preference always has been for stocks where earnings profile will be strong. So stocks like Bata, when market share gains can be very, very evident, margin profile to improve because of expansion in the ladies footwear category, which is a high margin product, a sustained capex in terms of improving its spread in tier 3, tier 4 towns will obviously add to volumes. Something like a TTK Prestige where government schemes incentives should work out.
Well, Mayuresh, hold on to your thoughts. The markets are open. I will come back to you later. Let's
L&T Finance, Mayuresh, what's the call on this one? I mean, technically it was stuck in that range of 120 to 135 for quite some time. It seems to have broken out of that. 2 strong days of gains coming in. Would you be looking to get into this stock fundamentally?
So morning Dipanshu. No, clearly I think if you look at the entire NBFC universe, and L&T Finance was also not spared, and what the management commentary has been specifically after the Q2 numbers, I think the growth parameters probably are going to get softened a tad bit over the next 2 quarters. The cost of borrowing obviously inches up, and that does put incremental pressure in terms of NIMs and spreads. Having said that, again, I think the strong parentage that L&T Finance probably possesses at this point of time, the expectations that the asset liability mismatch is not there on the books, at least at this point of time, and they'll be able to service their debts as they mature over the next 1 to 3 years. I think that's a very encouraging sign. Now, one really needs to adjust earnings estimates for these well-capitalized, good-governed NBFCs from a short-term perspective. And with that effect, I think the earnings hit can be evident for this fiscal, and so will be the ROEs. So one really needs to do the comparison check in terms of expectations of ROEs and do a stacking against their cost of equity, which probably will have some downgrades in terms of earnings profile. But I think the overall balance sheet strength and earnings profile over the longer period of time as we tide over this liquidity freeze should be evident in numbers. Yes, they've got exposure to wholesale finance, which the management is expected to bring down. And again, I think the strong growth that one really sees in their consumer lending businesses, I think that should probably hold up. So anybody holding on should hold on, but within the NBFC universe, I think stocks like Chola, Shriram Transport is something that we prefer, or even something like an M&M Financial if I had to toss that one.
That's on an RBL bank. Mayuresh, what about you? Banking, I mean, we've seen a lot of strength return to IndusInd, IndusInd, ICICI and an Axis Bank, but you've had troubles emerge for a Yes Bank. There is now concern on RBL Bank, but you've had troubles emerge for a Yes Bank. There is now concern on RBL Bank as well. There was divergent brokerage reports coming in, one very bullish, one very bearish on that counter. And of course, there's that oversupply hang on a Kotak Mahindra Bank. Given that setup, how are you playing the banking names, especially the private banks?
So Dipanshu, I think we are playing a mix of the corporate and the leaders in the retail space. So banks like ICICI, Axis, which have posted a very good set of numbers, and the trajectory should continue for them, both in terms of asset quality pressures actually coming down. If you look at a percentage of their net stressed asset as a percentage of overall advances, that has come down pretty sharply. The kind of exposure that one really expects, specifically in terms of the power sector, and the telecom sector or the SME sector, I think that element of stress is also expected to come down. and the share of retail advances are improving very, very sharply. With strong capitalization, I think the balance sheet expansion is also going to be very, very strong for these banks. So from a price to adjusted book, our own sense is that banks like an ICICI Axis do look very, very interesting on a staggered way on declines to be invested in. HDFC Bank, on the other hand, again, I think a stellar performance in terms of advances. NIMs being maintained around 4.3. You're probably looking at the retail advances being around 55% of the overall book. And when you're probably talking about what kind of valuation can one ascribe even at the current level, if I need to adjust the value of subsidiaries at 125, 150 odd rupees, and then take into account the core banking operations, though it trades at a premium, our own sense is that the premium valuations probably get justified for the franchise that it carries. So very strong liability franchise, very strongly capitalized at 15.8 Tier 1 ratio. I think that probably augurs well in terms of how the stacking up might actually happen compared to a lot of its peers. So if I had to pick and choose, I think ICICI Axis, HDFC Bank.
Right, that's the word from Mayuresh. Mayuresh, a quick word. Anything you like in the hotel space of late, mid-cap hotel space or the small-cap hotel space? Just the way, again, the stocks have moved, I'm tempted to ask you if you have been buying any hotel stock or if you're liking or thinking about any hotel stock.
Yeah, vacations are around the corner for you, so I think hotel stocks are going to be in demand. But I think if you look at the operating performance, obviously I think Indian hotels, with the kind of commentary that they probably meted out, both in terms of ARRs actually improving, the utilization levels inching up, I think that creates a natural leverage onto their balance sheet. The second element in terms of cost optimization and the improvement of their operating margins substantially over the next few years does augur well for the bottom line as well. So yes, Indian hotels is something that I own, something that can be looked at by long-term investors. But within the mid-cap space, I think if I have to pick and choose, I think Lemon Tree Hotels look very, very interesting at this point of time. The own thesis is that it's probably showing profitability this time round. The profitability is expected to improve. Utilization levels at 78 odd %, far better than the industry. Yes, they're doing capex in terms of coming out with new properties in Pune and Mumbai. But again, I think the kind of elevated debt levels that we're probably seeing, I think that should start cooling off. And because the natural leverage will be played in terms of the balance sheet dynamics, my own sense is that the kind of profitability that this company can exhibit over the next 2 to 3 years can be phenomenal. So I think if I have to pick and choose for the hotel space in the mid-cap universe, Lemon Tree Hotels on declines can be a choice. Leverage is overwhelming risk factor, but my own sense is that with better accruals happening over the next few quarters and the end of the capex cycle, I think even those levels should start going down, creating the kind of earnings momentum that one really seeks.
Mayuresh, a couple of these cap goods, engineering, infra names, I mean, good results coming in Q2. Execution is definitely picking up, and order book guidance has been healthy as well. You've seen that for Siemens, ABB India, L&T, of course. Even the PSU companies, BEML recently won a mega order worth over 3,000 crore rupees. What's your sense here?
You're right, Pancho. I think the kind of results that have got exhibited by these capital good players have been very astonishing, and the kind of guidance that they've probably given with the order flows that they've probably won. One really expects that for a few of these companies, the government has front-loaded orders, and that can very well continue into Q3, because then you will probably be entering into the election phase where orders can then get postponed or delayed. Having said that, the management commentaries surrounding the operating performance and the expectations of operating margins actually stabilizing and gradually improving is a very healthy sign. What really comes out in terms of the private capex over the next few quarters will be a telling sign in terms of how the entire order book thesis and dynamics will pan out, and the execution thereof is going to be extremely critical. So if these companies are able to do this very well, manage their working capital, I think the kind of earnings profile improvement that one really expects these companies to exhibit can actually be on the higher side. So yes, I think something like an L&T, which is a solid company representing, I think, most sectors within the infrastructure space, actually looks very, very robust over the longer period of time. Out of the larger universe, I think ABB actually stands out in my opinion, along with Siemens, because because the kind of order books that they've got, the kind of execution parameters that these companies are embarking upon, and specifically in case of selective products, electrification products, for example, where their EBIT margin that's relatively higher at 12-13%, I think that will augur well in terms of margin improvement and the earnings upgrades probably to take place. So yes, I think something like an L&T within the broader universe ABB seems
the way, and then take a fresh call. Gentlemen, thanks so much for joining in this morning and running us through your reading of the markets. Fourth straight day of strong gains coming in on the street. 10,800 easily reclaimed, up about 0.7% right now. Similar to the